difficulties today. Thanks for joining us. We have February's production information and market updates from Justin Kringstad at the North Dakota Pipeline Authority. We'll begin with Director Lynn Helms right now with the director's cut.
Thank you, Bethany, and welcome everyone. Hope you enjoy the recording. If you have questions, please feel free to email those questions in, and we will respond as quickly as we possibly can. So quickly looking at the statistics for February of 2023, great news in terms of oil production. We jumped back well above 1.1 million barrels a day, 9% above the, increase of 9% over January, and then 16% above our revenue forecast. Coming along with that in February was an oil price of $72.43. That's actually 3.4%, a little over 3% below revenue forecast, but the combination well above revenue forecast, as was January. Today's oil price, 7% above revenue forecast, $80.51 is what we're estimating for today's price. Natural gas production was up 7% at a little over 3 billion cubic feet a day again. Not quite to our record production from September of 2022, but still a major increase. Interesting that the gas-oil ratio actually dropped again. We think that's temporary, but Justin has some interesting information to present on that. He's looked at it on a county-by-county basis, and we're trying to puzzle out what's happening there. When we look at rig counts, very stable in the mid-40s. I realize today's rig count being reported on our website at 41 is low. We actually have 47 rigs in the state. 6 of them are moving right at this time. And in the spring like this, with load restrictions on, that's a long and difficult process. So we can see some volatility in the rig counts. We did add 1 brand new rig to the state's rig count. So we are seeing that gradual, slow increase, and we hope to be adding additional new rigs as workforce becomes available and iron becomes available. And you probably saw in the headlines in the news that there's an effort to bring out-of-state workers in, actually international workers in, to grow our workforce in the oil and gas sector in the state of North Dakota. That's being run by former Lieutenant Governor Brent Sanford and the Petroleum Council. Good news on the weighing on completion, no big increase there, January to February, and inactive wells dropped, almost 100 wells January to February. We stayed in pretty good shape on completions, a big increase into February and then a drop in March. Again, there's some volatility there with frac crews and that stuff that's going on with frac crews. I believe we're showing 21 frac crews working in the state at this point in time. Things pretty stable on Fort Berthold Reservation, and very good news, good solid numbers coming in on gas capture. Even though we're seeing extremely low natural gas prices, we're estimating $1.75 a thousand cubic feet for natural gas going into Northern Border System at Watford City. That's at a record or near record oil to gas price ratio of 46. So a lot of pressure on companies with regards to gas capture, but people are really holding the line. Our companies, our operators are really holding the line in terms of gas capture. Nationwide, U.S. natural gas storage is 19% above the 5-year average. And crude oil inventories are slightly above average in the U.S. and worldwide. But the big news there, of course, is the announced surprise cuts by OPEC. So done a little digging into that. There are a handful of reasons being tossed about by the OPEC Plus folks on why they cut production. Number one reason is that the U.S. backed away from refilling the SPR. And they were looking to that as being a point of price support. Now they look at it and say, well, that could cause worldwide inventory problems, and so we're going to make the cut ourselves. They also made a promise 3 years ago that they were going to be very intolerant of speculation in the oil and gas markets. And most recently, most of the investors, most of the speculators in the crude oil markets worldwide were going short and predicting decreasing oil prices. So OPEC Plus decided to give them a sharp left turn and push prices up instead. They're also looking at potentially weaker demand as we go through this year and into next year with the banking crisis and some of the financial problems worldwide. So a handful of reasons given there, but number one and number two was the U.S.'s decision not to refill the SPR, even though oil prices were at the target prices, and the problems with the world oil markets selling short when OPEC sees the need to push oil prices up slightly. Interesting developments on the federal agency side of things. I'll just end with that. But we were extremely happy that Judge Traynor here in Bismarck, our federal judge, ordered the BLM to hold quarterly lease sales and to find parcels that are available to lease and to consistently hold those quarterly lease sales in compliance with the Mineral Leasing Act. So that was great to get that preliminary injunction there. Now, we are working on the Bureau of Land Management environmental impact statement to revamp their resource management plan. That could have decades of impact on the state of North Dakota, and so we'll be submitting robust comments on that. And then, most interestingly, or also as interesting, it just keeps coming, is that the Bureau of Land Management has published a new rule proposal that would treat conservation as its own separate category of multi-use land management and would treat it on par with resource extraction, grazing, recreation, all those other things. So we've begun to dig into that. There's a lot to hate about that rule proposal, and so North Dakota also will be providing robust comments on that. We are at that point in the typical federal administration where they've had about 2 years to work on putting their policies into rule proposals, and so we expect to see lots of rule proposals rolled out as this year unfolds. In fact, one of the slides that we've been using with the North Dakota legislature is called The Great Train Wreck, and it's a PowerPoint slide that's got dozens of rule proposals that are coming out from DOI and EPA and Corps of Engineers and everyone else that are have the potential to really impact North Dakota energy production. So with that, I hope that you gathered some valuable information. I'm going to turn it over to Justin. And again, a reminder, email us your questions, and we'll turn those around as quickly as we can. Thank you very much.
Well, good afternoon, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. I'd encourage you, whether you're listening to this on replay or listening to it live, this slide deck is available online, the press event slides. So, again, if you're watching this on replay, a lot of the slides will speak for themselves, but I'll walk through some of the highlights, starting on the production side as we take a look at what's happening with our neighbors in eastern Montana as well as South Dakota. South Dakota holding relatively steady. Eastern Montana, some preliminary numbers coming in. Some of the same challenges we had in December and January. In North Dakota, we were seeing similar type of trends on the western portion of the Bakken play, seeing some production numbers slightly down in that region as well. When we take a look at month-to-month changes, as Lynn mentioned earlier, the one most puzzling component for myself, and we're going to continue to dig into this, was another month-over-month decrease in gas oil ratios here in the state of North Dakota. It's not uncommon when we look back historically to see ebbs and flows on that general trend up. I'm going to continue to dig in with some other folks as well on trying to answer whether it's geology, whether it's geography, whether it's timing, whether it's chemistry, whether it's ambient temperatures, what is driving this sustained now 5 or 6 months of continued decreases in gas oil ratios. So stay tuned. Hopefully we find some answers, but the anticipation is that general trend, though, even with a number of months down, we are still planning and expecting for that trend to continue upwards and having to address the midstream issues that would come with a general upward movement of gas oil ratios within the basin. Slide 5, if you're moving through the deck, that's just an updated map. Again, maybe causing more questions than answers as we're first taking some quick looks at the data from January to February in particular. When we look at crude oil movements for the month of February, we saw a general slight shift in barrels being moved by rail car as opposed to, by pipeline as opposed to by rail car. The market, we certainly have enough pipeline capacity with Dakota Access and our other PADD 2 and PADD 4 pipeline systems in order to move those volumes, and the market conditions in February were such that it was driving any of those flexible barrels that had that marketing option back onto the pipeline movements. When we look at what the refiners are paying around the U.S., we're continuing to see PADD 1, that East Coast, PADD 5 on the West Coast being the highest priced destinations. As we know, we can get a Bakken barrel to the West Coast at a lower price than we can to the East Coast. So purely economics, and when we look at where those barrels are going, it's no surprise that we're seeing more of those barrels headed to the Pacific Northwest than over to the East Coast. But by and large, if someone's looking for just a general estimate of how much crude was moving out of the region by rail car in February, it was right in that 90 to 100,000 barrels per day was the estimate, with roughly 3/4 of it heading to the Pacific Northwest and the remaining volume headed to the PADD 1 in the Atlantic coastline. When we look at what prices are doing as of today, we've got just under a $4 spread between Brent and WTI. When we look at the economics, that would, in my mind, tell me that those barrels are going to continue to prefer that pipeline movement. So I'm not expecting a rush or a big shift anytime soon in how those barrels are leaving North Dakota. For those looking at the slide deck, a couple of these numbers didn't get refreshed correctly. Bakken at Clearbrook was $1.91 premium, and that LLS premium is $1.98 as of today. So both of those markers down slightly from what they were last month, but again, still in a real positive situation for those North Dakota barrels as they move through that PADD 2 area, and as that influences back to the wellhead price for those producers, royalty owners in the state of North Dakota. On the imports and exports, as we move through that, nothing really major to write home about on that front. Continued strong news on the gas capture side, 95% capture, 5% flaring, with again consistent challenge being flaring from those wells that are connected, but again not having adequate capacity in order to move every molecule that's being produced at that location. Some other positive news on the gas capture front it would be slide 15 for those following along. We had more wells selling gas than new wells producing gas in the month of February. So again, even though that winter month, real strong connection numbers by the midstream companies, which is always encouraging. We want to see gas connections at or above the pace of completions and drilling. So very encouraging news on that front. In April, a couple big numbers came out for those that like to track various forecasts for oil prices and what those may mean. Not only did the EIA come out with their short-term outlook that you can find on slide 16, as well on their website, they did refresh their annual outlook out to 2050 for crude oil prices. Generally, we saw about a $10 per barrel increase from their 2022 outlook, so they have a real strong crude outlook for pricing. That's going to bode well for a play like North Dakota over the long term. Again, prices well north of $60, $70, $80 in those outward years. We've got significant inventory and opportunities here, so the long-term outlook continues to look very strong. We look at some additional processing, and then we'll go downstream from there. Still sitting in a very good spot for gas processing locally at the moment. Still looking at that 2026 to 2027 time frame before we're going to need additional gas plant capacity in the basin. And then last but not least, I'll just touch on some of the residue, the interstate gas dynamics. Continuing to see here, even in the last week or so, less Canadian flow coming through. We're seeing some open capacity exiting the Glen Olin area. We're seeing just, again, generally less pressure from some of the Canadian markets as of late. There's some maintenance and other things changing those dynamics, but for the time being, residue transmission capacity appears to be in very good shape, and we're still looking at, again, at that 25 to 27 time frame before we're starting to need additional residue solutions out of the basin. And then on the last thing, on the BTU numbers on slide 20, again, we're still hovering right around that 1100 level. If we see or we don't see some of those Canadian volumes tick up, how that works is those Canadian volumes coming into the basin, typically drying out that Glen Olin blended number, and we're going to likely see some upticks if we don't get some more Canadian flow coming through that system. And again, not that it's not allowed to exceed 1100, but it's just a benchmark that we watch, just given past FERC rulings and discussions surrounding Bakken gas quality exiting the Williston Basin. So with that, again, as Lynn alluded to as well, reach out with questions, comments. I'd be glad to answer either by phone or by email. Thank you very much.